While bear markets are never pleasant, it's important to remember that these periods of downward volatility are quite common and have historically been relatively brief compared to the much longer bull market periods, and are the price we all must pay for the excess returns that the stock market has historically generated over the long term. Let's delve further into each of these points in the remainder of this video. First, as the chart here demonstrates, bear markets are quite common, having historically occurred in the US stock market roughly every 5 to 7 years. Recently, however, we've been spoiled because the index in our backyard, the S&P 500, just experienced an extraordinary 11-year period from 2009 to 2020 of unusually steady price increases. Furthermore, the 2020 bear market that broke this streak, while high in percentage decline, was both abnormally short and followed by rapid and prodigious gains as a result of the unprecedented stimulus the government instituted to fight COVID-related economic problems. Going forward, however, it's probably wise to prepare for a more historically normal cadence of bear markets. This chart here shows 65 years of investing history, which we believe is a reasonable enough approximation of an investing lifetime. Of course, future returns and volatility could turn out to be better or worse than the past, but we think a sensible investor's base case should include at least as many down periods as we've historically experienced. Thus, we should all reasonably expect to experience roughly 12 periods of greater than 20% peak to trough losses, 6 periods of greater than 33% losses, and 3 periods of approximately 50% losses during our lifetime. Now, we all wish we could avoid these periods by selling out of and buying back stocks at just the right time. But because of the radical unpredictability of both the economy and the stock market, we've never been able to find any convincing evidence that supports the notion that an investor can consistently achieve this desired downside volatility avoidance. In fact, all the academic research supports the contrary position that all equity investors are likely to experience multiple painful periods of portfolio price declines. Even Warren Buffett, widely considered to be the greatest investor of all time, has experienced at least 3 approximately 50% declines in his net worth. The unfortunate reality is that there is no way around these periods. Rather, the best we can all do is to persevere through them. The second thing to remember about bear markets is that they have historically been relatively brief compared to the much longer bull market periods. As you can see here, bull markets have typically been many multiples longer in duration than bear markets, and their price gains have usually more than made up for any losses experienced during the bear market periods. Of course, in the moment, bear markets feel endlessly long, but this graph reminds us that our current bear market will end, and that if history is any guide, the bull market that emerges is likely to be much longer in duration and much more powerful in scope. The graph also reminds us that equity investing has, over the long term, grown investors' wealth, which leads us to our third and last point about bear markets. Bear markets are, unfortunately, the price we all must pay to capture the excess returns that equity markets have historically generated. And these excess returns have been sizable and consistent, as can be seen in this chart here, which demonstrates that stocks have handily outperformed government bonds and bills in all 23 of the countries with continuous capital market histories during the period from 1900 to 2021. And while we find this chart to be incredibly compelling, its one downside is that it doesn't adequately demonstrate the power of compound growth. This downside is significant since, as researchers Matthew Levy and Joshua Tassoff write in one of the many studies on exponential growth biases, we humans systematically underestimate the magnitude of compounding interest and are overconfident in our ability to answer questions that involve exponential growth. In our experience, this lack of appreciation for compound growth causes most people to vastly underestimate the benefit investors have historically been able to achieve if they're willing to put up with the stock market's higher volatility. For a demonstration of this extraordinary benefit, let's turn to possibly our favorite chart on equity investing. As you can see in this chart from 1900 to 2020, both US and UK stocks performed dramatically better than bonds and bills. US stocks were a particular standout, multiplying real wealth by an almost unbelievable 2,291 times versus only 12.5 times for bonds and 2.6 times for bills. UK stocks also produced incredible results over this time period, multiplying real wealth by 572 times versus only 10.4 times for bonds and 3.4 times for bills. Of course, barring major medical breakthroughs, a 120-year period isn't a very useful period for most of us to consider. However, 50 years certainly is, and over the period from 1972 to 2021, even with a smaller annualized excess return over bonds, as you can see here, US stocks multiplied investors' purchasing power by 27 times compared to just 6.8 times for bonds and 1.3 times for bills. Just as we do with the graph of bull and bear markets we shared earlier, we find it tremendously helpful during bear markets to review these charts comparing the long-term performance of stocks, bonds, and bills. They remind us that the benefits of long-term equity investing have historically been both universal and enormous, and that if we persevere, we will likely be richly rewarded. Bear markets are painful and psychologically dangerous. The pain of losing money can cause us to shorten our time horizons and can even distort our views of reality, causing us to overweight the importance of the negative sum forces currently plaguing us, such as war and political polarization, and underweight the importance of the historically much more powerful positive sum forces of cooperation and human innovation. As an antidote to this emotional pain and the distorting effect it can have on our view of reality, we have found it helpful to remember 3 things about bear markets. We will experience many of them during our investing lifetimes. They have typically been brief and followed by longer and more powerful bull markets. And they are, unfortunately, the price we all have to pay for the enormous excess returns that long-term equity investing has historically provided over government bonds and bills. In summary, while the current bear market has resulted in significant mark-to-market losses, it is our belief that if history is any guide, the highest prices are yet to come. All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.